Hello everyone. Our next topic is valuation of securities. Securities means financial assets which can be divided into two. One is fixed income securities, one is variable income securities. As the name suggests, fixed income securities means any securities which provides a fixed amount of revenue to the holder of the securities like bonds and preference shares. They are considered as fixed income securities, whereas variable income securities which provide you fluctuating rate of return which totally depends upon the profitability of the companies like equity shares is known as variable income securities. In this chapter we are going to value all these securities, bonds and equity shares, and for that we need to find out the intrinsic value. Now what is this intrinsic value? Intrinsic value means the true value or the real worth or fair price of the financial assets. So we'll start with the bond, valuation of bond. So bond, what is bond? It is one of the financial assets, debt securities which is issued by the borrower and purchased by the lender or investor. The future expected cash inflows from this bond are in the form of interest and redemption value. So therefore you can say that this intrinsic value of a bond or present value of a bond is divided into two parts. One is present value of interest and one is present value of redemption value. Now what is this present value concept? We have already discussed in financial management that time value concept, time value of money. It is the value of money which is different in different time period. Therefore, we are supposed to find out the present value of annual interest income or whatever the intervals given to you, or redemption value or the single amount which is given to you at the time of maturity. So before starting the valuation of bond, we must know about the basic terms which is or which are related to the bonds. One is par value, which is also known as face value or the nominal value or the principal amount which is stated on the face of the bond securities, say rupees 100, 1000 or any amount. However, issue price may be less than, equal to or more than the par value. Say company can issue their bond with whose face value is 100, company can issue at 960, so it means less than the face value, or company can issue at 1100 which is more than the face value. Next important term is coupon rate. As we know that every securities promise you some kind of a interest, and debt security also promise a rate of interest periodically, say annually, semi-annually or quarterly or any other interval. It is known as coupon rate. It is the fixed rate of interest that you will earn. Next one is maturity or the maturity value or redemption value. It is the maturity of a bond. It refers to the period from the date of issue after the expiry of which the redemption payment will be made to the investor by the borrower firm. This is the theoretical concept before we start our valuation of bond.